Welcome to The Deep Dive. We're the show that takes your sources and really digs into them to pull out the insights you need to be genuinely well-informed. Today, we're plunging into a really fascinating and, frankly, high-stakes topic, the market's critical juncture for this coming week, July 21st to 25th, 2025. We've got this comprehensive market strategy report right here. It's packed with economic data, earnings forecasts, insights on the Fed. Our mission today, to give you a clear point of view, a strategy really for making sense of these conflicting stories we're seeing. You know, the market's favorite soft landing idea versus these emerging signs that growth might be cooling while inflation stays stubborn. It honestly feels like standing at a crossroads, and we're here to basically hand you the map.
It's quite something, isn't it? The tension is palpable. You've got these headline indices like the NASDAQ hitting record highs, but often driven by just a handful of mega cap tech names. It's a very narrow leadership. And then you look underneath at the forward-looking indicators, and they're whispering about a potential slowdown. Maybe more than whispering now. So this week isn't just, another week on the calendar. The catalyst we're expecting, they're going to put that whole soft landing belief to a serious test.
Okay, yeah, let's unpack that central conflict then. It seems to spin around three things that are all tangled up. The economic data that's coming out, how the Fed reacts, and this interesting disconnect between Fed Chair Powell's words and what the market's actually betting on. What's the core tension you see for the Fed itself?
Exactly. I think the core question for the Fed, and well, for all of us watching them, is pretty straightforward. Are these reports going to show enough cooling? Enough to justify what they call a dovish pivot, actually starting to think about cutting rates? Or is inflation, especially those sticky parts, going to how around, force them to stick to their guns with this higher for longer stance? It's a real tightrope walk.
And the main event for getting a read on that is definitely Fed Chair Jerome Powell's speech. That's Tuesday, July 22nd. I mean, look at the futures markets. They're basically saying it's a 50-50 shot for a recut in September, a coin flip.
Which leads to, I think, a really crucial point. It goes a bit beyond just the usual Fed guessing game. We have to think about how Powell frames the economic impact of tariffs. He's been talking about this more lately, hasn't he? He even said their effects could be more persistent, not just a one-off price jump.
Yep.
And that's not just casual commentary. It's strategic. By pointing to tariffs, an external thing, fiscal policy, not the Fed's direct responsibility, he kind of builds this narrative shield. It lets them say, hey, maybe we hold rates steady because this inflation isn't just the economy overheating, it's this policy shock from trade. It subtly shifts the focus.
Right, so he's almost nudging the administration, suggesting maybe trade policy needs to change before the Fed eases up. That's a really interesting angle for you to track. But wait. If tariffs are causing persistent inflation, no matter the source, doesn't the Fed still have to deal with it? Does that narrative shield really work if inflation stays hot?
That's the million-dollar question, isn't it? And it's why his exact words matter so much. Yes, they have their mandate, inflation and employment, but by highlighting fiscal policy, he's implicitly arguing, look, our tools like rate hikes aren't the best fix for this particular kind of inflation, supply-side, policy-driven stuff. It gives them cover to hold steady, maybe without needing to hike more, even if inflation is still too high. So what you should listen for, specific keywords. If you hear resilient, strong labor market, well-anchored expectations, that signals no rush to cut. He's confident. Also, listen very closely to how he talks about tariffs. Is their impact transitory or persistent? Persistent is the word that should make markets nervous. That's more hawkish. And finally, how does he describe the recent data? If he emphasizes strong jobs, that's hawkish. But if he even hints at slowing private sector growth, that could be seen as dovish. If he doesn't sound worried about a slowdown, you can assume their base case is still decent growth, making rate cuts seem further off.
Got it. The nuance is everything. Okay, let's shift gears slightly. Let's look at the specific economic data points this week, the ones that could actually move the needle for the Fed and for the market. First one up is Thursday, the S&P Global Flash PMIs. Now, sometimes these PMIs get overlooked, but our sources are really flagging them as critical. Why so important?
Oh, they're absolutely vital because they're literally the first wide-ranging look we get at how the economy performed in July. Think of them as like an early snapshot. They're seen as really good, timely predictors for GDP, inflation, even jobs. So yeah, They matter. Now, the market will look at the main numbers: manufacturing expected around 52.4, services 52.9, both above 50, so still expanding. That looks okay on the surface. But the real story, the thing you really need to watch, is buried in the subcomponents, specifically the inflation parts. And what's been fascinating and honestly a bit worrying is the split we're seeing. Headline activity seems solid enough, right? But that prices paid part of the index, it's been accelerating sharply. And guess what gets blamed?
Tariffs again.
Tariffs again. The June report was explicit. Nearly 2/3 of U.S. manufacturers directly linked higher input costs to tariffs. And this isn't abstract economic theory. It led to the biggest jump in the prices companies charge at the factory gate since way back in July 2022. Think about it simply. Tariffs make imported materials more expensive for businesses. Eventually, they have to pass that cost on. That means higher prices for consumers, stickier inflation. So if this report shows activity may be slowing a bit, but that prices paid number is hot again, that's a stagflationary signal. Slower growth, higher inflation. That's the market's nightmare scenario. On the flip side, if we finally see those price pressures easing, especially the tariff-linked ones, that would be incredibly bullish, a huge relief.
Wow, okay, that really highlights the direct link. Moving on, we also have housing data, Wednesday and Thursday. Existing home sales forecast around 4 million, and new home sales forecast about 0.65 million. Housing is always seen as being right in the path of Fed policy, right?
Absolutely. It's probably the most direct channel. Higher rates hit mortgages immediately. What you want to watch for here is a potential divergence, a split. Let's say new home sales come in stronger than expected, but existing home sales stay weak. What does that tell you? It signals the housing market's activity is becoming more reliant on home builders.
Why does that distinction matter?
Because builders have tools individuals don't. They can offer financing deals, buy down mortgage rates to make homes seem more affordable. Individual sellers, they're often stuck, locked in by the super low mortgage rates they got a few years back. They can't compete on financing like builders can. So strong new home sales might look good for builder stock, sure.
Yeah.
But it also hints at underlying stress in the broader market. It suggests demand isn't entirely organic. It's propped up by incentives, makes it seem a bit artificial and maybe more vulnerable if the economy weakens. That's a good pulse check on the consumer.
That makes total sense. A shiny surface, hiding potential weakness below. Okay, last big data point. Friday. Durable goods orders. The headline number looks scary, expected down like 11% in June after a big jump. But that's always volatile, isn't it?
Yeah, the headline swings wildly because of things like big aircraft orders. You're right, it can be misleading. Sophisticated market watchers, the pros, they'll look right past that. They focus on a different line item: non-defense capital goods orders, excluding aircraft.
Right, the core CapEx number.
Exactly, core CapEx. It's a much cleaner read on what businesses are actually planning to spend on equipment and expansion. It's a better gauge of corporate confidence, really. The consensus forecast is pretty weak, just a tiny 0.1% gain. Now, if that number misses, if it comes in negative, that's far more significant than the headline plunge. It would be concrete evidence that maybe policy uncertainty, like those tariffs Powell keeps mentioning, is actually making companies nervous, making them pull back on investment. That would be bad news for sectors like industrials, materials, and it definitely punches a hole in that neat soft landing story.
Okay, crucial distinction there. Ignore the headline, watch core CapEx. Got it. So shifting from the big economic picture to company specifics, Q2 earnings season, it's in full swing. And our sources say, yeah, 83% of S&P companies are beating estimates, which sounds great. But the actual year-over-year earnings growth, it's the lowest since late 2023. So a bit of a mixed picture. This week, we get reports from some real heavyweights, bellwethers that could set the market's mood. Let's start with Alphabet, GOGL. They report Wednesday after the bell. Huge for digital ads, huge for cloud. What's a key focus here? Revenue looks solid, around $93.8 billion expected.
Right, revenue growth is expected to be decent. But the conversation around Alphabet, it's really shifted. It's less about just top-line growth now. The big focus, the debate among investors, is capital discipline. Can Alphabet keep growing while managing these absolutely massive costs tied to the AI race? We're talking, what, planned capital spending around $75 billion next year? That's enormous. So the metric everyone will zoom in on is the operating margin, expected around 34.1%. Here's the tricky part. If they beat on revenue, great. But if they miss on the operating margin, that would be seen pretty negatively. It suggests costs are spiraling and maybe faster than revenue, raises questions about the long-term profitability of this whole AI build-out. They really need Google Cloud to perform well. That 26% year-over-year growth expectation is key to help offset those big spending concerns.
So for Google, it's not just if AI pays off, but when and at what cost.
Fascinating. Okay, next up, same day, Wednesday after close. Tesla.TSLA. The report seems less about looking back at Q2 and more about, well, what story they tell about the future. Precisely. The stock's been kind of stuck, hasn't it? Deliveries were down, competition's way up. Expectations for the actual quarter that just ended are pretty low. Revenue expected down about 10% from last year. The market seems to have already factored that weak auto performance in. So how the stock reacts, it's going to depend almost entirely on management. Can they pivot the narrative? Shift the focus to the future tech, the higher margin stuff. We need tangible updates, robotaxi network, any real progress. The cheaper next-gen car, where is it? And the energy business, is it growing meaningfully? Those are pivotal. Keep an eye on automotive gross margin, too. Expected around 16.4%. That's down from 18.3% a year ago, so that trend matters. But maybe the biggest potential catalyst, whether they bring back full-year delivery guidance for 2025. They pulled it last quarter. Reinstating it, even if cautious, would give investors that roadmap they desperately want.
Yeah, Tesla always feels like it trades on the future narrative more than the present reality. Okay, finally, HCA Healthcare. HCA, they report Friday morning. One of the biggest hospital operators gives us a unique window into medical spending, but also, crucially, how financially healthy consumers are feeling.
That's exactly right. Analysts expect a decent quarter, revenue around $18.46 billion. But like with the other reports, you need to look deeper than the headlines. The most insightful thing, maybe the canary in the coal mine for the broader economy, is the patient-payer mix. In Q1, HCA did well partly because they saw strong growth from patients with good insurance-managed care, exchange plans. Those pay better. If we see that trend reverse, specifically, if there's a noticeable rise in uninsured patients or more patients relying on lower-paying government plans like Medicaid, that's a big red flag. It signals financial stress. People might be losing job-based insurance, maybe due to layoffs or reduced hours. It's not just about HCA's profits, then. It tells you something powerful about the health of the U.S. consumer and potentially the whole economy. A very direct signal.
That's a really sharp point. Makes you think about the hidden signs of economic strain. Okay, let's tie this all together. What does it mean for the market this week? Our sources are clear. The S&P 500, the NASDAQ, they're priced like a soft landing is happening. But that forward PE ratio, around 22.2, it's high, makes them vulnerable. The report lays out two main ways this could play out.
Right. First, there's the bull case scenario. Let's call it Goldilocks confirmation. Everything goes just right. This would mean Alphabet and Tesla deliver strong guidance. They emphasize future growth enough to make people forget any current weakness. But crucially, that needs to happen alongside the flash PMI report showing a real meaningful slowdown in those price pressures. Inflation cooling off. If Powell's speech then comes across as balanced, keeps that September rate cut possibility alive, then you'd likely see the NASDAQ take the lead, pull the S&P 500 higher. Renewed excitement about big tech, basically. Market breathes a sigh of relief.
Okay, that's the sunny scenario. What about the other side? The bear case, the stagflationary scare people worry about.
Yeah, this is the one that could sting. It gets triggered if that flash PMI report delivers the bad news combo, slowing growth and inflation that's still sticky. That nasty mix. Then if Powell's speech sounds hawkish, maybe he really leans into those tariff inflation risks, downplays any need for cuts soon, the market would have no choice but to slash expectations for a September cut, maybe price it out completely. And then, if Alphabet or Tesla stumble, weak guidance on their main businesses, failing to sell that future story, that could easily spark a broad sell-off, a risk-off move. And with those high valuations, the NASDAQ, the tech-heavy index, would probably get hit harder.
Yeah, you can really see how it all connects, how these scenarios hit different parts of the market. Tech and communications tied to Google and rates, consumer stocks watching Tesla and consumer health. Healthcare, looking at HCA's payer mix, industrials, financials reacting to durable goods, and the Fed. Every single piece matters for where your money is invested. So this week really calls for heightened vigilance. Extra attention, the potential for some real swings, some volatility feels pretty high as these big narratives clash. Understanding these specific data points, knowing what to listen for in the earnings calls, that'll give you a genuine edge in figuring out where things might be headed.
It really will. And, it makes you step back and ask a bigger question, doesn't it? In a market that seems to react so fast to every headline, every bit of Fed commentary or earnings guidance, how much of the current price really reflects deep fundamentals versus, just chasing the latest story or the latest interpretation of Powell's mood? It's something to think about.
That is a powerful thought to chew on. And a perfect spot to wrap up this deep dive. To make sure you're always getting the fastest updates, the most frequent analysis like this, be sure to subscribe to the deep dive. You really won't want to miss what we explore next.